that trade can be an act of war, and I think it's led to bad things.
The greatest investor in modern American history just told 40,000 people in Omaha that the tariffs being used by his own country are, quote, an act of war. Then he sat on the largest cash pile any company has ever assembled, $397.4 billion, and he refused to deploy a single dollar of it back into the U.S. stock market. His name is Warren Buffett. The number is real, the quote is real, and the trade he is making with his cash is one of the most aggressive defensive moves in the history of capital allocation. On February 24, 2026, the Trump administration's 10% universal baseline tariff officially went into effect on nearly every product imported into the United States. It was the second time in less than a year the same administration had attempted this. The first attempt, the Liberation Day tariffs of April 2, 2025, was struck down by the Supreme Court in February 2026 in a 6-3 ruling that obligated the federal government to refund $166 billion in unlawfully collected duties to over 330,000 businesses. This is the largest trade policy shift since 1971, and the man with the longest investing track record on earth is positioned for what comes next. Let me start with the regime itself. The current 10% universal baseline tariff was implemented on February 24, 2026, under Section 122 of the Trade Act of 1974. Section 122 is an emergency authority statutorily capped at 150 days. That means the baseline is legally scheduled to expire on July 24, 2026, unless Congress acts. The administration has signaled a planned escalation to 15% before the deadline, but as of May 2026, that faces near certain litigation. On top of the baseline, separate Section 232 national security tariffs remain in place: 25% on steel, 10% on aluminum, 25% on imported automobiles and parts, 100% on patented pharmaceuticals, with reduced rates of 10 to 15% for the EU, UK, and Japan, 25% on advanced computing semiconductors, including the NVIDIA H200 and AMD MI325X. So, a steel import faces an effective barrier of 35%. The August 2025 executive order also closed the de minimis exemption. The legal foundation collapsed in February. On February 20, 2026, in Learning Resources versus Trump, the Supreme Court ruled 6-3 that the International Emergency Economic Powers Act does not grant the president the authority to impose revenue-raising tariffs. Chief Justice John Roberts, writing for the majority, used the major questions doctrine to curb executive overreach. The ruling struck down the entire Liberation Day framework. Customs and Border Protection now has to refund $166 billion across roughly 53 million customs entries. The administration's pivot to Section 122 is the legal lifeline keeping the current tariff alive. Now what Buffett said. In a March 2025 interview on CBS Sunday Morning, just weeks before Liberation Day, Buffett delivered his blunt assessment. On who actually pays a tariff, he said, quote, "I mean, the tooth fairy doesn't pay them," end quote. On the consequences, he said, quote, "They're an act of war, to some degree," end quote. That phrase became the defining critique across financial media. Then, on May 3, 2025, at the Berkshire Hathaway annual meeting in Omaha in front of 40,000 shareholders, he doubled down. Quote, "There's no question that trade can be an act of war, and I think it's led to bad things. We should be looking to trade with the rest of the world, and we should do what we do best, and they should do what they do best," end quote. He then warned about American exceptionalism. Quote, "It's a big mistake when you have 7.5 billion people who don't like you very well, and you have 300 million who are crowing about how they have done. The more prosperous the rest of the world becomes, it won't be at our expense," end quote. Now Buffett's successor. On December 31, 2025, Buffett retired as CEO and handed the keys to Greg Abel. On February 28, 2026, Abel published his first annual shareholder letter. He did not repeat the act of war phrasing, but he was explicit. He wrote that tensions from developing trade policies and tariffs had created considerable uncertainty that could result in adverse consequences on Berkshire's operating businesses and equity investments. Now, Berkshire's actual exposure, BNSF Railway, the cross-border freight artery, is being squeezed by tariff-driven volume compression on the West Coast import flow it depends on. Precision Castparts, Berkshire's aerospace components business, is sitting on a $45 billion long-term backlog, but the 2025 annual report cited cost and supply chain headwinds in 2026 from tariffs on raw aerospace metals. GEICO was hit hardest. The 25% automotive parts tariff inflated claims severity directly. GEICO's first quarter 2026 underwriting earnings before taxes fell to $1.4 billion, a 35% decline of $757 million compared to the same quarter the prior year. Policies in force grew only 2% year-over-year, while Progressive grew at 11%. So here is what Berkshire did with the capital. They sold. For 14 consecutive quarters, Berkshire has been a net seller of equities. In the first quarter of 2026 alone, they sold $24.1 billion in stock and bought only $15.9 billion. The cash and treasury bill pile grew from $373.3 billion at year-end 2025 to a record $397.4 billion by the end of March 2026. For the first time in modern history, cash represents more than 30% of Berkshire's total assets, larger than the entire public equity portfolio. And when Abel did deploy capital, he deployed it outside the United States. On March 23, 2026, Berkshire put $1.8 billion into Tokio Marine Holdings, Japan's largest property and casualty insurer. Berkshire also continued expanding its $35 to $46 billion position across Japan's 5 major trading houses: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo, funded with yen-denominated bonds at coupons between 1.35% and 3.12%. Now, the historical precedent. The Smoot-Hawley Tariff Act of 1930 raised duties on more than 25,000 imported goods. As the bill neared passage in late October 1929, the stock market collapsed and the Great Depression accelerated. The 1971 Nixon shock is the closest mechanical parallel. President Nixon imposed a 10% surcharge on all dutiable imports, bypassing Congress. Same mechanism, same percentage. The result was severe inflation, sharp yen appreciation, the end of Bretton Woods, and massive supply chain disruption. The 1987 Reagan tariffs imposed 100% duties on Japanese semiconductors and inflated U.S. computer hardware costs without reviving domestic chip manufacturing. Trump's first trade war in 2018 to 2019 drove the S&P 500 down 19%. Every major broad-based tariff regime in modern American history has been followed by a recession, a market correction, or both. The market reaction to Liberation Day was violent. On April 3, 2025, the day after Executive Order 14,257 was signed, the S&P 500 plunged 4.84%. The next day, it fell another 5.97%. Across 5 trading days, the S&P fell more than 11%. The Dow lost over 4,000 points. Domestically insulated software and defense names did fine. Palantir surged 40% in April. CrowdStrike gained 21%. Industrials and luxury names were decimated. The market only recovered after the administration, under pressure from Treasury Secretary Bessent and Commerce Secretary Lutnick, issued a 90-day pause on the reciprocal hike. The corporate damage is real. General Motors revised its 2026 earnings hit from tariffs to $3.5 to $4.0 billion. Ford raised prices on Mexico-produced models by up to $2,000 to offset $2.5 billion in trade war costs. Caterpillar absorbed a $350 million hit in a single quarter, watched operating profit drop 18%, and estimated full-year tariff burden between $1.3 and $1.75 billion. Deere projected a $1.2 billion pre-tax annual expense and laid off more than 200 workers. Apple absorbed $800 million in tariff costs in the third quarter of 2025 and projected an additional $1.1 billion quarterly drag. Tim Cook called the tariffs a, quote, material drag, end quote. Walmart's first quarter 2025 profit slipped to $4.45 billion from $5.1 billion. The macro impact is even larger. Tax Foundation analysis shows the average effective tariff rate hit 7.7% in 2025, the highest since 1947. Average U.S. household tax burden, roughly $1,000 in 2025 and an additional $700 per household in 2026. Goldman Sachs models the peak effective rate at 17% and estimates corporations will pass 70% of the cost onto consumers. JP Morgan projects core PCE inflation will remain around 3%, putting the Fed's 2% target out of reach. The Yale Budget Lab forecasts that if the current Section 122 tariffs become permanent, US GDP will be persistently 0.1 to 0.16% smaller, an annual loss of roughly $27 billion. Now, the bull case. Council of Economic Advisors Chair Stephen Moran and Commerce Secretary Howard Lutnick reject the consensus on free trade. They view the chronic $1 trillion annual U.S. trade deficit as an unsustainable disequilibrium. They view tariffs as geopolitical leverage to force a restructuring of global trade. The ultimate goal is what Moran calls the Mar-a-Lago Accord, an echo of the 1985 Plaza Accord, where tariffs are weaponized to compel foreign governments into a managed dollar devaluation. Foreign holders of U.S. treasuries would be pressured to swap into ultra-long-term, low-yield century bonds. The fatal flaw is that America's largest creditors today are geopolitical rivals who could choose capital flight over compliance, dumping the dollar and triggering a sovereign debt crisis. Smart money is positioned. Stanley Druckenmiller dumped his entire stakes in Meta and ARM holdings in the fourth quarter of 2025 and rotated $113 million into Brazilian equities through the iShares MSCI Brazil ETF. The trade gained roughly 20% in early 2026. Ray Dalio warned the tariffs would create, quote, great sand in the gears of production worldwide, end quote. Daniel Loeb of Third Point reversed an early bullish call after the Liberation Day crash. So, what should you do? 3 things. First, recognize the system. The 10% baseline tariff has a hard expiration date of July 24, 2026. Either Congress extends it, the administration tries to push it up to 15% and gets sued again, or the baseline disappears overnight. The volatility itself is the trade. Second, examine your portfolio. If you are long an S&P 500 index fund, you are long the heaviest tariff-exposed sectors in the world: autos, industrials, retail, semiconductors. Third, copy the structure, not the position. You do not need $397 billion. You need 3 to 6 months of expenses and a treasury ladder so that when the next tariff escalation or court ruling rips the market, you have optionality. The greatest investor of the modern era called the current trade policy an act of war. He sold equities for 14 quarters straight. He deployed his only major new capital outside the United States. The signal could not be louder. If you want to see which stocks the smartest investors are quietly buying right now, watch this video next and subscribe. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.